Well, the way it panned out was that in keeping in line with their objective, they reduced the amount on offer, and we saw about 58 billion sold across the tenors from 10.9% to 12.08% at the 364-day bucket.
Okay, so Wale, would you say that, because last week some of the things that I heard from a lot of analysts was that the market was very, very liquid indeed. How would you rate system liquidity at this time?
System liquidity, with the maturities we have, if you take into consideration system liquidity with the maturities, the market should be liquid to the tune of about 800 billion, and that is considered quite high. With the issuance today, that just takes way less than 10% of that. So the market remains liquid.
Now, while the IMF just put out its World Economic Outlook for April, and quite a number of bright spots there. It said the global growth quickened to 3.8% year-on-year. It also said that some of the key drivers include rebound in trade, stronger growth across developed and emerging markets, and expecting growth in emerging markets to quicken to 4.9% this year. Now, what does this mean for bond investors? How do you see bond investors interpreting this data?
For looking at that outlook, we have about 3.9% expectation for global growth. For Nigeria in particular, I think 2.1%. Most of this growth, considering the EM markets, is based on strong rebound in commodity prices. Oil price at around $73 per barrel today. So once there's growth, there will be lots of investment. You would expect there will be lots of investment. So that should create a bearish sentiment for the fixed income market. There's going to be lots of investable funds going into fixed income, bonds, treasury bills. And African markets being of, given the high yields we are offering, I'm sure there will be lots of interest in our economy.
So Wale, are you in any way concerned about the IMF's warning that although a lot of emerging market economies had returned to growth, if there were another economic shock and commodity prices crashed again, we could see a repeat of 2015 and 2016?
Yeah, I agree with you. But if you look at Nigeria, take Nigeria as a case in point, our reserves have grown from $27 billion to about 47. So I think we have been able to build enough base to withstand any further shock that might come, if there were to be another shock. Looking at the global markets, there's the talk about U.S. protectionism, the trade wars. There's lots of consideration. What would Africa do? What does Africa stand to benefit from this? I think what we can do in this part of the world is continue to build up our reserves and look inward and try to build up our own local production space as well.
Now, with the reserves on the rise, I think currently at 47 billion US dollars right now, help us understand how the naira has fared in the last, say, 2 weeks. I know that the CBN has been pumping dollars into the market, both at the official and, of course, at the interbank market too. Yeah.
The central bank has continued with its weekly intervention, injecting about $210 million weekly into the market at the retail, wholesale, SME, and invisible sectors. So that has kept buyers confident. They are sure there's steady supply. They are not bothered about, worried about front loading because the central bank is there for them. At the investors and exporters window, you still see stable supply, stable demand. You even have people willing to wait, looking for better rates, and you find suppliers offloading to the central bank when they actually don't have takers for their funds. So I would say the market is relatively stable, and we expect this to continue.
So another thing that I remember reading from the IMF is that there seems to be some pressure towards devaluation, especially on Nigeria. And then I look at rates and I look at myself as an individual, and I think that the rates are pretty low. So how likely do you think it is for the naira to fall even further than it has, do you think?
360 naira to a dollar I would consider is fair. And the IMF's major concern is the unification. They are not happy about the multiple rate structure we have, and they have tried to convince the government to unify the rates, and as this would help businesses plan their models. And in the overall interest of business, I think we should have a unified structure. We are aware the central bank is working towards this gradually, but it's going to take time.